Whenever the economy gets shaky, inflation rises, markets get volatile, or currencies lose strength, people start looking for safety. And one asset always comes back into the spotlight: the gold. But is buying gold actually a good idea today? What type of gold should you buy? And how do you avoid the classic mistakes new investors make? In this video, I will walk you through the essentials, supported by a few key charts, so you can make informed decisions and invest with confidence. Let's start with the big picture. Gold isn't a get-rich-quick asset. It's a wealth preservation tool. If you look at this price over the last 20 or 30 years, you will notice a clear pattern. It rises sharply during crises, it stabilizes during calm periods, and overall, it trends upward over time. This long-term resilience is exactly why gold has been considered a store of value for thousands of years. It's not about explosive growth, it's about protecting what you already have. Let's take a look now to this chart, the gold versus inflation. The real reason people buy it. Inflation is the silent enemy of your savings. When prices rise, your money buys less. Gold, on the other hand, has historically kept pace with inflation and often outperformed it over long periods. It doesn't do this perfectly year by year, but when you zoom out, gold acts as a shield against the erosion of purchasing power. That's one of the strongest arguments for owning it. Now, a common question is gold better than stocks? Is gold better than bonds? Or cash? Or better than crypto? The truth is, gold isn't trying to compete with them. It plays a different role. Stocks are for growth. Cryptocurrencies are for speculation and high risk. Gold is for stability. When you combine gold with other assets, you reduce volatility and create a more balanced portfolio. So gold isn't a replacement, it's a diversifier. Another interesting angle is understanding who's driving demand. Most people think gold demand comes mainly from investors, but that's only part of the story. Globally, demand is split between jewelry, investments, central banks, and some industrial uses. This mix is important because it stabilizes the market. When one sector slows down, another often picks up the slack. And another important point is why central banks are buying so much gold. In recent years, central banks have been buying gold at levels we haven't seen since the 1960s. Why? Because gold is one of the few assets that isn't tied to another country's currency, isn't dependent on a financial system, and holds value during geopolitical tensions. When entire nations are increasing their gold reserves, it sends a strong message. Gold remains a strategic asset. We could saw it during the Russian invasion of Ukraine or nowadays with the Iran war. Let's do now a comparison of gold investment types, because not all gold investments are the same, and here's a quick breakdown. First, you have the physical gold, which are the coins or bars. You own the metal directly. That's great for long-term security. It requires storage and sometimes insurance. Then you got the gold ETFs, which is the backed by physical gold. It's easy to buy and sell, no need to store anything, and good for beginners and liquid portfolios. Finally, on the top of the roof, you've got the synthetic products or the gold paper. These are the futures contract derivatives. There is much higher risks, more complexity, and it's only for advanced investors. And last but not least, is not here included, but you will have the gold mining stocks. These don't track gold perfectly, are more volatile, and can outperform gold when prices rise. The right choice depends on your goals: security, liquidity, or growth. So, should you buy gold? Gold won't make you rich overnight, but it will help protect your wealth from inflation, crisis, and market turbulence. The key is understanding what type of gold fits your strategy and how it complements the rest of your investments. Stay safe